Hi, and welcome to our end of December and end of year update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple, battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easier to calculate and adjust each month, for those who are new to the concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So it's the end of year review, end of 2015. We're going to review how the 20-month moving average system has been doing. We're going to review how the MRI system has been doing. We're going to review how the Ray Dalio portfolio has been doing. And we'll review the rules for dealing with a stock tip, the 25% trailing stop system. But first, here's a review about the S&P 500 index. From December 31st to now, it looks like it's been doing nothing. In fact, nominally, it's only down 0.7%. And if you add in dividends, it's actually up 1.25% with dividends. But when people look back at this year and think this was a pretty bland year in stock history, actually, if you remember, anyone who's lived through 2015, it's been a pretty rough year. It's gone up to as high as 3.6% in May of 2015, and then went down to 9.3% in August. And I don't know if you remember all the news that have been going on and all the doom and gloom stories been going around. But this is all reflected in the stock price, and at the end of the day or end of the year, it's ended up pretty much where it began. So how do our systems do? Well, the first system we'll review is the 20-month moving average. So remember the rules. If the price of the S&P 500 index fund is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. The 20-month moving average is our safety belt. It only works if we watch it every month. So how does this work? This blue line is the S&P 500 index fund, the VFINX. I use this fund just because it has more data than any other fund. And the corresponding 20-month moving average line, the red line. So if you take a look at the end of December, the fund ended at 188.48. The moving average is 184.13. So the fund is above the 20-month moving average. According to the system, it's relatively safe to be in stocks, specifically in this index fund, for the next month. And for those of you who are still on the fence and not sure about whether or not to go in because maybe it might fall, if you take a look at the ratio 188 to 184, there's a 2.4% cushion. In other words, if the stock drops 2.4% by the end of January, that will be our signal to get out next month. But for this month, it's relatively safe to be in the index fund. So how's this worked out for us so far? Remember that if we sell the S&P 500 index fund when it's below the 20-month moving average, we can either hold cash or buy a bond fund with the cash. So here's what's going on historically. Since 1986, 1 year, if you bought, held, and prayed, the index fund returned 1.25%. The 20-month moving average system lost 8.0%. And that's because we did have a whipsaw back here in September. There was also a whipsaw here in 2011. So over 5 years, when the index fund went up 79%, this system only returned 36%. But when you look 10 years, when there was actually a bear market, both systems returned roughly 100%. And over 20 years, when you have two big bear markets to deal with, this is when our system shines, returning 643% versus 373% for just buy, holding, and praying. So this is how whipsaws hurt our system. If you take a look at the blue line, this is the S&P 500 index fund. The red line is the 20-month moving average line. And this black fund is what we would have done by doing our system. And if you're wondering why we were in stocks, but why the black line has been trailing the blue line, it's because, again, if you were to have a professional like me do this for you, we have to subtract fees. So this is a brutally honest graph taking into account all fees. So if you take a look at what's been going on since our high in May, stocks have been drifting down until finally in September it actually went below the 20-month moving average line. So according to our system, at this point we went out of stocks and went into bonds. But of course, as fate would have it, this particular time stocks immediately bounced right back up, whereas bonds went down. So we did lose out on this gain, and we did lose out because bonds went down, for a total of 9% difference. And then, because the stocks are now above the 20-month moving average line, we switched back into stocks, and that's why we have this parallel line staying with our 9% difference. So how do we do overall? If you don't like graphs, here's a table since 1987 comparing the S&P 500 index fund compared to our system. Our system, we've had 4 losing years so far, including this year, compared to 5 of the S&P 500 index fund. And you notice the magnitude of these losses: 37%, 22%, 12%, 9, 3. Our system lost 8, 2, 12, 8%. And overall, when there are big bear markets since, for instance, 2000 to 2002 and 2007 to 2009, our system protected us from the bigger losses when it counted. So annualized, you get 9.3% from the buy, hold, and pray strategy with the S&P 500 index fund versus 10.8% with the 20-month moving average system. So that 1.5% difference is a difference of 140,000 versus 205,000 had we hypothetically invested $10,000 at the beginning of 1987. Now, what about the whipsaws? Have whipsaws happened in the past with this system? Yes. In 1988, there was a whipsaw. That's why we lagged 9% here. 2011, we had a whipsaw, so we lagged 14% here. And we have a whipsaw here, 2015, so we lagged 9%. Whipsaws happen. Again, this is a price we pay. No system is perfect, but this is what we're trying to protect against, the big downturns in 2000 and 2007. So lessons of this month: no system is without risk. The weak spots are whipsaws. Out one month, in the next. So the next system is the monthly rotation investment system, or the MRI system. This system is completely different than the 20-month moving average. There are no similar rules between this system and the previous system. Don't mix up the two systems. If you're going to do this system, stick with this system. If you're going to stick with the 20-month moving average system, stick with the 20-month moving average system. Don't combine the two. So the MRI rules. Every month, there are 3 mutual funds that we're going to rank: the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. Every month, rank which one did the best, then sell the bottom 25% of your portfolio and buy the top fund. There is this distinction. The portfolio is your account, basically. So, for instance, if you had a $100,000 account, if you sell the bottom 25%, you're selling the bottom $25,000 worth of your portfolio to buy the top fund, which is one of these mutual funds, whichever one came out on top that month. So how does this work? For this month, last month data, this month data, divide, divide, rank, rank, and we have a winner. This month, it's the inverse fund. And here it is, a graphical representation. The green is the inverse fund, the blue is the index fund, and the red is the emerging markets fund. Now, it is a clear winner, but again, this month has been remarkably flat. They're almost exactly 0%, kind of like the whole year. And this came as a surprise to the markets and the news, just because everyone was expecting the Santa Claus rally, and if you remember what was going on this month, it's pretty tame. So with this method, this month we're going to sell 25% of our portfolio and use it to buy the inverse fund. So here's mechanics. Last month we were 75% index fund, 25% inverse fund. If we were to sell the bottom 25% here and buy the inverse fund, we would be roughly 50% inverse fund, 50% index fund. And since one inverse fund cancels one index fund, last time we were roughly 50-50 index fund cash. Now we can be 100% cash. So this saves us on a commission. So how has the MRI been doing to date? So since 1994, this year the MRI lost 13.05% compared to the index fund gaining 1.25%. And you can see on this graph, yes, it has been going down. Over 5 years, it's been drifting around, gaining 4.0%, whereas the index fund gained 79.4%. But if you take a look at 10 years, again, this is when we actually had a bear market, the MRI returned 123% versus the index fund 100%, and then 20 years, the MRI returned 709% versus the index fund 373%. So a closer look at what happened in 2015. Why did we do so badly compared to the index? Well, number one, remember the index was pretty choppy, went up and down, up and down, up and down, and this is exactly the weak spot of the MRI. Remember in the beginning of the year, stocks were still going down, so we were finally 50% inverse fund, 50% index fund. We were in cash basically, that's why it's flatline here. But when we went to cash, that's when stocks went up. Because stocks went up, at the end of this month, we were long stocks. But then stocks went down, and of course we went down, and we became cash again. While we were cash, stocks went up. So we went into stocks again, and vice versa, all the way up until we had 2 down months in a row. So when we were long the stock, because here we were long the stock, we lost, and then we were in cash. But then because it lost again, we were actually in the inverse fund, and we were inverse fund when the stocks went up. So we went down again. Because the stocks went up here, we were in cash again, and then because the stocks went up here again, we were in stocks again just when it started to go down. So in terms of timing, cycles matter. In other words, if a cycle is a long-term cycle, years, several months, we can detect it and rotate into it appropriately. However, if a cycle is within weeks, that's too fast for our system to catch, and they're usually meaningless to begin with. But when a cycle just happens to be between half a month to 1.5 months long, this is when we start to get these little micro whipsaws, and this is when it starts to really detract from our system. How does this work in long term? if you compare since 1995, the S&P 500 index compared to the MRI system, the MRI has lost 4 years compared to the index fund has lost 4 years. The magnitude of the losses are relatively small compared to the index fund, and in fact, it's when there's massive losses is when we actually start gaining. And this is what saves us at the end. When all said and done, the annualized return of the index fund was 9.1% versus 11.2% since 1995. In other words, had we hypothetically invested $10,000 in 1995, we would have $66,000 now compared to $100,000 with the MRI. So graphically to date, let's look at this historically again. Yes, it's been going down. Have there been periods in the past where we've been trending down as well? Yes, they have. Back in 2011, back in 2008, before we caught the uptrend and we started going up. And of course, there are many times when we've gone up, but we've lagged the major bull market. But that's exactly how this system works. We try going slow and steady and avoid the large bear markets. And that makes the whole system work. So lessons of this month with the MRI. Again, no system is without risk. Every system has weak spots. The MRI weakness is during times of ambiguous trend, mini whipsaws become more frequent. So MRI, because we are actually trading every month, there is a cyclicality to what we're doing. So if there's a cyclical frequency that just happens to be within 0.5 to 1.5 cycles per month, that's when we would start to get whipsawed. So next system is the Ray Dalio portfolio. There's really no rule, it's just a pie chart and rebalance once a year. And I introduced this in my videos last year when Tony Robbins published his book publishing Ray Dalio's particular pie chart. Now, for those of you who are not familiar with Ray Dalio, he is a hedge fund manager, which is an understatement. In a world where $15 billion hedge funds are considered huge, Ray Dalio's is $160 billion large. In fact, he's so huge that heads of state have him on speed dial on their cell phones. Just like how a lot of investors try to follow Warren Buffett, a lot of traders try to follow Ray Dalio, and for a long time people haven't been able to crack his code, how he allocates his resources before he does his thing. Well, according to this book and his interview, this is the portfolio that he uses. 30% stocks, 15% intermediate term treasuries, 40% long-term treasuries, 7.5% gold, and 7.5% commodities. I backtested this utilizing these particular funds and ETFs. And here's the backtest results. The stock, intermediate term, long-term treasuries, gold, and commodities. If you take a look at the weighted pie chart, you see that there have been 4 years when there have been losses. And yes, this year has been the largest since, and it's lost 4.5, almost 4.6%, with an annualized return of 7.6%. Considering that stocks annualize 8.9%, but gives you a lot more headache with these large drawdowns, this is a pretty robust system. And in fact, if you were to take 11% after taxes for our tax bracket is roughly 7.6%. So since a pie chart is one where you pretty much buy, hold, and rebalance every year, which means very little actual turnover, you can actually use this more effectively in a non-retirement account. So here it is, Dalio's pie chart in graphical form. If you take a look at all these components compared to the dark black line, which is the pie chart, it's a pretty smooth line. again, it pretty much beats most of the other components except for the stocks with very little of the market crashes. So our last system that we'll go over with, it's the 1% risk trailing stop. The whole theory behind this is that if you must invest in a particular stock instead of a mutual fund or an ETF, you don't want to risk more than 1% of your portfolio, of your account on any one stock. So if you have a 25% trailing stop loss on your stock, in other words, a stop loss where if the stock falls 25% from its high, the system will automatically sell that stock for you. You can buy 4%, up to 4% of your portfolio worth of the stock, so that if it ever stops out, at most you'll lose 1% of your portfolio, unless it severely gaps down. If you have several stocks, you can do the same thing with all these stocks, and if one stock goes up more than 33%, you can buy another block of stocks using another 4% of your account. And this way again, you're never risking more than 1% on any one stock. And just repeat until stopped out. I can't give you an update on that particular strategy just because this will be highly dependent on whichever stocks you happen to choose. So in summary, remember we have many different systems. Don't mix up systems. Rules for one may not necessarily work well with rules of another. Do not change rules in the middle of the system. If you want to change the system altogether, but make sure that you've at least backtested that new system that you're proposing just to make sure that you understand where the weak points are. Sometimes in theory, systems work, but if you tested them out, a lot of times they just don't work. So we've reviewed the 20-month moving average system, the MRI system, the reality portfolio, and glossed over the basics of dealing with stock tips. So keep those questions coming. I know I talk to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague. Here are ways to get in touch with me. Seriously, drop me a line, give me a call, email me to set up a consult. A few of you I've talked to, you know your stuff, you're fine. I don't have to worry about you. But for some others, holy cow, it's clear you need help getting your financial life in order. Don't be bashful of reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.